We got some big news for Rivian stock investors as the company reported their quarterly production and delivery numbers. These numbers were much higher than the same quarter last year, but Rivian stock still fell because investors understood why the numbers were higher. It's because consumers were trying to get ahead of the electric vehicle tax credit that's ending, and all electric vehicle sales captured a boost in the most recently completed quarter, even though many of the buyers of Rivian's vehicles are not benefiting from that $7,500 tax credit. But if certain vehicles, if they were being leased, could be benefiting from that. And overall, there was a benefit from consumers having more interest in electric vehicles before those tax credits expire.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Rivian reported that they produced 10,720 vehicles at their manufacturing facility in Normal, Illinois, and delivered 13,200 vehicles. Unfortunately for Rivian, the management team reiterated their outlook for 2025, actually downgraded it slightly by 500 vehicles to a midpoint of 42,500. The previous midpoint was 43,000 vehicles forecasted for delivery for 2025, which would be lower than what they delivered last year. But the quarterly figures were better. In the same quarter last year, the company delivered just 10,018 vehicles. So year over year, there was a nice increase for Rivian, which has struggled to generate growth here in 2025. In fact, in 2024, the company produced and delivered around 50,000 vehicles, and this year they're expecting a significant decrease down to 42,500, which is about 15% lower than at the same time last year. Unsurprisingly, Rivian's share price was down. Following this news, investors were hoping that this positive delivery figure for the current quarter would lead the management team to upgrade their full year outlook for electric vehicle sales. Less than 1 out of 10 vehicles sold in the United States are electric vehicles. It hasn't caught on the way it's caught on in other parts of the world like China and Europe, where people have better choices in terms of lower priced options. Most electric vehicles in the United States are more expensive than their internal combustion engine counterparts, and it's a lot more inconvenient. The charging infrastructure is not well established here, and so unless you have a home where you can charge your electric vehicle, looking to the public charging networks is unattractive for most buyers. In fact, it's so unattractive that Ford CEO said that as these electric vehicle tax credits expire, he's expecting, and he wouldn't be surprised if that share of electric vehicles, remember how I highlighted it's roughly 1 in 10 vehicles sold are electric vehicles? Ford CEO is forecasting that it's going to fall by half. It's going to be less than half out of every 10 sales is an electric vehicle, or in other words, 5 out of 100 only electric vehicles sold next year as those tax credits expire, and it becomes more favorable for companies to produce cars that people want to buy and not just produce electric vehicles because the government is forcing you to produce these electric vehicles or face stiff penalties if you're not producing enough of these lower internal combustion engine styles. So I've had Rivian stock as a hold, and I've been actually warning investors not to buy this stock for several years now, ever since it reached those highs in 2020, 2021. I've warned investors that this is not an attractive investment, and it looks even less attractive now. The big catalyst coming for Rivian is next year when they hope to produce that lower priced model and sell it for $45,000. Of course, that model is going to be hurt with the removal of that $7,500 tax credit, which would have been available to that model, but now that's most likely out of the question. And now the company has to struggle with making sales of those $45,000 models if they are able to produce it at that and sell it at that price point and compete against other internal combustion engine vehicles that are likely to have similar features at lower price points. but that remains a big catalyst for the company, which could drive an increase in sales and make the business more attractive as they utilize more of their manufacturing capacity, which right now they're only utilizing a fraction of their manufacturing capacity. So they're losing billions of dollars on the bottom line because they paid for that capacity and they're not utilizing it. And so the lower capacity utilization rate is hurting their sale, hurting their profitability, and hurting their cash flow from operations. So hopefully for Rivian stock investors, the company launches that lower priced model and it facilitates more sales, which then you could consider this company for investment. As it stands right now, I don't think this stock is investable at current market prices.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.